Building your investment portfolio is a bit like making a sandwich. Similar to how you choose different ingredients to create a tasty sandwich, you also need to choose different investments to create a diversified portfolio. Most people don't mind the odd sandwich for lunch, but not everyone is going to like the same filling. The same concept can be applied to your investments. Your investment portfolio can be as unique and personalised as you want it to be. Just how you might choose from a variety of meats or cheeses and veggies for your sandwich, a well-diversified portfolio also includes different types of assets. In this video, I'll explore some of the benefits of diversification and demonstrate how you might choose to allocate your investments across different asset classes. I'll also share some practical tips and strategies that will help you to build a diversified portfolio that suits your individual needs. So whether you're a new or experienced investor, stick around and let's explore how to build a successful investment portfolio, one ingredient at a time. Before we get on to that, make sure you've done your financial health checks, which include things like paying off high consumer debt or setting up an emergency fund. I talk about these checks in my Investing for Beginners video, so be sure to check that out after this one. So the very first step is to understand the difference between defensive investments and growth investments. Investments are a bit like a pair of jeans. There's just no one size that fits all. Different investment products suit a different range of people based on many factors, including how long they want to invest for, the returns they hope to achieve, and just their appetite for risk. Defensive investments are low risk, low reward. They tend to focus on generating regular income rather than growing in value over time. The two most common types are cash and high-interest savings accounts or fixed bonds. These are suited to people who want to diversify their portfolios and meet short-term financial goals in around 2 to 3 years. Growth investments, on the other hand, are high-risk, high-reward assets that focus on generating returns that can grow over time. Popular examples include shares or property. These type of assets can provide pretty good returns, anywhere from 5 to 10% per year, possibly even more. But they also have the potential to have really bad years as well. Not only that, but in a worst case scenario, there is no 100% guarantee of your capital ever being returned. These kind of high risk, high growth investments are better suited to long-term investors who have an investment horizon of about 5 years or more. Growth investments tend to have different levels of volatility and therefore risk exposure. Asset classes like cryptocurrencies, foreign exchange currencies, and commodities come under this higher risk umbrella. For example, crypto is definitely a high risk investment with potential high returns, but I also think it comes down to how you interpret risk and reward. In financial markets, risk is usually correlated with volatility, but it could be argued that volatility isn't risk per se. The random ups and downs of an investment value is only a concern if you're investing for the short term or if you rely on your investment for income, for example, in the form of dividends. If you're a homeowner, you wouldn't sell out if the price of your house fluctuated by a few percent each week or month. So to me, as a long-term investor, risk could be defined as the probability of losing your entire investment. But obviously everyone is different and your tolerance and willingness to take on risky investments will depend on many things, such as your current financial position, risk appetite, and of course your time horizon, which is really important. Typically, the older you get, the more you might want to start adding defensive assets into your investment portfolio to conserve your wealth rather than accumulate. So we've covered the juicy growth investments and the plain defensive investments that you might want to include in your investment portfolio sandwich. Let's move along the conveyor belt and run through the range of ingredients you could add to your investment portfolio sandwich going forward. So the first one is based on an asset that I talked extensively about in my last video, and it's probably my favorite to invest in. You guessed it, that's ETF. ETFs are exchange traded funds where instead of your stock just buying you a share in one company, for example buying an Apple stock, you get a whole basket of different companies with your one share. This is usually less risky than buying one individual stock because your portfolio will be diversified across a number of different companies. Most ETFs are passive investments, which means that they aim to mirror a market index rather than outperform or beat it. Generally, the returns that you can expect from ETFs vary. It all depends on what your ETF is actually tracking. An ETF should have an average return of at least 7 to 10% to match the S&P 500 benchmark, which tracks the performance of the top 500 companies in the US. ETFs are considered a growth investment because they comprise of shares. However, they're less risky than individual stocks because you're buying a group of different companies. Individual stocks are actually another ingredient you could add to your investment portfolio sandwich. These are less diversified than ETFs and can expose investors to more potential risks. However, if you only wanted a portfolio of individual stocks, you could make it quite diversified by owning multiple stocks and adding to the collection over time. There are many opinions and even studies conducted on how many stocks equal a diversified portfolio, from 5 stocks to 50 stocks, but all of this is actually irrelevant if the company stocks themselves aren't properly diversified. For example, are you investing in a broad range of industries instead of just tech stocks or energy stocks? And is there a good range of company sizes in your portfolio, such as large cap and smaller cap stocks? Buying 50 shares in the financial services sector would expose you to huge risk if there was a global banking crisis looming, for example. Within individual stocks, there are many different categories and classifications. Too many to go into this video, but I'll just touch on some of the most common. Blue chip stocks are probably the most well known among retail investors and are basically the cream of the crop in the business world. They feature well-established companies with strong reputations, companies like Microsoft, McDonald's, Coca-Cola, etc. that have been going for a really long time. Unlike speculative stocks, they don't tend to provide the highest returns, but their stability makes them favourites among investors with a low risk tolerance. Speculative stocks are stocks that investors speculate might do well and are usually penny stocks or an emerging market stock that carry high risk compared to blue chip stock. Although these types of investments have the potential to achieve amazing returns, long-term investors tend to stay away from them because of the high volatility and the increased chance of losing your money altogether. Unless you've got time to research each speculative investment, it's best to avoid them altogether or at least invest in them via an ETF if you can. Alternatively, there are also dividend stocks and capital growth stocks. Dividend stocks pay out a share of the company profits to the shareholders on a regular basis and are good for providing a regular income from your investments without having to sell down any of your positions. For instance, there are many YouTubers out there documenting their lives living off dividend income through dividend stock investing. Dividend stocks are typically offered by large blue chip companies that are so big and profitable, their priority is no longer reinvesting 100% of the profits back into growing the business, but instead they distribute this to their loyal shareholders. On the other hand, shares in capital growth companies won't tend to have a high dividend, if they even offer one at all. Some companies just aren't yet profitable, or if they are, will prioritize reinvestment of the profits to propel growth. You'll find this to be the case with small and large companies, and it definitely doesn't mean that companies in their high growth phase aren't good investments. High growth companies can see their stock price rise much higher than a blue chip company could ever pay in dividend yield. Examples of large companies that don't pay dividends include Amazon, Meta, who own Facebook and Instagram, and Alphabet, the parent company of Google. All of these companies adopt a growth strategy in the hope that one day the value of the company and its share price will appreciate in value. Another ingredient you can add to your investment portfolio sandwich are mutual funds. Mutual funds allow you to pool your money with other investors to mutually buy stocks, bonds, and other investment products. A fund manager will buy and sell assets on the fund's behalf to produce capital gains or generate income, and they'll usually invest in a variety of different investment products such as stocks, bonds, or other alternative investments. They're actually really similar to ETFs in that they provide diversified exposure to an asset class, region, or a specific market niche without you having to buy lots of individual shares. But because they're actively managed, their fees tend to be a bit more expensive. Another difference is that mutual fund trades can only be executed once a day at a single price, whereas ETFs are exchange traded, so it can be bought and sold for as long as the markets remain open. Like ETFs, mutual funds come in many varieties designed to meet different investor goals and risk levels. Overall, mutual funds fall into one of 4 main asset classes: equity funds, which invest primarily in stocks; fixed income funds that invest in bonds or other debt instruments; alternative funds such as property, private equity, private debt, etc. or you can have a mixed asset fund that dabbles in all of the above. They're generally considered a safer bet than individual stocks purely because of the diversification they can offer across the board. To add a bit more flavour to your investment portfolio sandwich, you could also invest directly into property. Property can be a great investment and has the ability to produce consistent and steady returns, as well as passive income. The upside of property is that there's less volatility, and it acts as a good diversifier against stocks because real estate isn't tightly correlated to the securities market. Not only can you earn an income from property investments in the form of rent, you can also benefit from capital growth and an increase in equity over time. One of the biggest cons of investing in property, though, is the initial high cost. If you don't have a lump sum sitting in a bank account somewhere, it can take time to save deposit. In order to purchase an investment property, you would need at least a 25% deposit, which based on the average UK property price is a deposit of over £70,000. Whereas if you wanted to invest with shares, you could start with as little as £1. Another con is that property is an illiquid asset, which means it takes a really long time to convert the asset into cash. If you think about the buying and selling process of a house, it could literally take months, sometimes a year, to settle on a property, which is a really long time if you need the cash urgently. Along with high entry and exit fees, you also have the cost of maintaining and managing the property and its tenants. There may also be void periods where your property isn't tenanted and you're not earning yourself an income or paying off the mortgage. Factors such as rising mortgage rates, unfavourable tax treatment, and tightening regulations is proving a challenging time at the moment for buy-to-let investors, especially those that are highly leveraged. But as a property professional myself, it's something that I'm really keen on. If you do want exposure to the property market, but you don't actually want to purchase a physical property, another asset that you can add to the mix in your portfolio are REITs. REITs are real estate investment trusts and are essentially companies or trusts that own or invest in income-generating real estate. As an investor, it means you're able to earn dividends from real estate investments without having to buy, manage, or finance the properties themselves, which is a great benefit. Because you're able to buy and sell shares in these REITs like a stock on the stock exchange, this makes them highly liquid assets. Unlike physical property investments, they're a great way to hold a share in all sorts of property, including apartment buildings, data centres, office blocks, shopping centres, even the ugly mobile phone towers no one wants on their street. Another asset you could look into to load that investment portfolio sandwich are fixed-term deposits or bonds. These are fixed-term investments, so you will need to keep your money invested for the duration of the term, which can range from 1 month to a few years. How they work is that you deposit a sum of money with a financial institution where your money is locked up for a set period of time. In return, you're paid a fixed amount of interest on the account balance. The interest rates on these products tend to be slightly higher than those of normal deposit or savings account, where you can just withdraw your money at any time. The downside is that you can't withdraw your money before the term ends without incurring some kind of penalty charge or losing all of the interest earned. Also, the rates of these term deposits can struggle to keep up with inflation in certain environments. The best interest rates out there at the moment for a 1-year fixed term deposit is about 4.5%, which is still much better than the rates that you're able to get in early 2022. Fixed term deposits are an extremely safe investment and therefore appeal to conservative low-risk investors. Another product you can invest in to build your portfolio sandwich are bonds, and they tend to be low-risk, low-return investments as well. When you invest in bonds, you're essentially lending money to the government or a company. By buying a bond, you're giving the issuer a loan, and they agree to pay back the face value of the loan on a specific date and pay you periodic interest payments along the way. Unlike shares, bonds issued by companies give you no ownership rights whatsoever, so you won't necessarily see any benefit from the company's growth. But on the flip side, you won't be exposed to much risk when the company isn't doing so well either, as long as it stays solvent so it can pay down its loans. The benefit of holding bonds in your portfolio is that they provide a stream of income and also offset some of the volatility that you might see from owning stock. Government bonds, referred to as gilts in the UK or treasuries in the US, are generally considered the safest possible bond options because governments are usually more stable than companies, because they can raise taxes if needed to cover their debts. So I've covered most of the popular ways you might want to consider building a diverse investment portfolio. It's really up to you to undertake your own research and understand which products and investment mix is best for you and your strategy. If you're looking for some alternative ways to spice up your investment portfolio sandwich, there are a few other asset classes you might want to look at to supplement those we've already covered. Precious metals, specifically gold, are a good way of preserving wealth. If you had bought an ounce of gold towards the end of 1990 at the going rate of £200 and at the same time kept £200 in cash, the gold would now be worth 650% more. However, the cash would not have increased in value at all, and due to inflation would actually be worth less. Gold is traditionally seen as a safe haven because it's usually negatively correlated with the stock markets. The price of gold tends to rise when other markets fall and vice versa. You could actually own gold physically in the form of gold coins or gold bullions, but you can also buy and invest in digital gold or buy a gold ETF, which is way more flexible and probably more secure than keeping gold bars under your bed. Cryptocurrencies are also another alternative investment to consider. They are essentially virtual or digital currencies which are supported and maintained using a technology known as blockchain. There are about 23,000 cryptocurrencies in circulation at the moment, and while some cryptos have total market valuations in the hundreds of billions of dollars, others are completely worthless. You can also stake your crypto by locking it away for a set period and earn a passive income through interest. Crypto isn't everyone's cup of tea though, and if you're thinking of getting into it, it's probably better to start with one that is commonly traded and relatively well established in the market. However, be aware that cryptocurrency is a hugely volatile and speculative investment, and nobody knows which, if any, of the cryptocurrencies will be the winners of tomorrow. Therefore, you should only really invest what you're prepared to lose should the worst happen. There are quite a few more alternative investment options, which I'll maybe address in another video if that's something you want to see, as I'm conscious this video is getting quite long now. Important ones to cover are commodities, which are essentially any raw materials that are grown or mined, such as corn, wheat, oil, or even livestock such as cows. Again, buying and selling commodities can be risky because prices can widely fluctuate at the drop of a hat. You've also got peer-to-peer lending, where private investors invest cash in non-bank companies that give commercial and personal loans. In the UK, this type of investment even has an ISA dedicated to it. Sticking with the private investor theme, it's also possible to go down the private equity route in the form of seed funding, whereby an investor invests capital in a startup company in exchange for an equity stake or share in the company. It's possible to do this via angel funding or crowdfunding websites, but again, very risky given that unfortunately 60% of startups don't make it past their third year of trading. Some other quirky alternative investments include currencies through forex trading, carbon credits, art, stamps, or other collectibles that potentially rise in value over time. Just think Pokemon cards, for example. So those are most of the ingredients that you could potentially add to your list for a tasty investment portfolio sandwich that's right for you. Taking a look at my own investment portfolio now, you'll see it's somewhat varied and will definitely change over time. The biggest portion of my investments are actually held in my pension at 44%. The next biggest portion is held in stocks at 35%. I also hold 18.5% as cash in a high interest savings account. I then have a few smaller investments of 2% in cryptocurrency and 0.5% in seed funding for startups. I'm quite comfortable with this mix for now, but it will be interesting to see how this changes over time as I look to increase my position in some of the alternative investments. But for now, I'll probably just keep it as it is. With that said, I'd love to hear from you guys. What do your portfolio splits look like, and have you really given them much thought? Do let me know in the comments below. Thank you so much for watching all the way to the end. Be sure to hit the like and subscribe button on this video, and I'll see you in the next one.